Hi all, good evening and welcome. I am Divya Gopalakrishnan, and on behalf of CareEdge, I welcome you to our today's discussion on the story of India's soaring securitization market. We sincerely appreciate your time in joining us for this webinar. We would like to welcome our esteemed guest speakers for today, Mr. Shankar Tripathi, Executive Vice Chairman, Aadhar Housing Finance Limited, Mr. Vikas Jain, Chief Financial Officer, Hinduja Leyland Finance, and Ms. Aditi Deshpande, National Credit Head, Aditya Birla Finance. This session will be moderated by Vineet Jain, Senior Director at CareEdge Ratings. We will commence this session with a presentation by Sriram Rajagopalan, Associate Director, CareEdge Ratings. This will be followed by a panel discussion and a Q&A session. In case of queries, participants are requested to key in your panel. We will take up your queries during our panel discussion session. Now, may I invite Sriram to make his presentation.
Thank you, Divya. Good afternoon, everyone. We extend a warm welcome to our esteemed guest speakers and all attendees to this webinar on the story of India's soaring securitization market. We have compiled a short presentation and follow this up with a panel discussion. Please note that the views of the panelists and their individual views and may not necessarily represent the views of the institutions that they may be working with. We will start with a short synopsis for today's event. The securitization market has witnessed rapid growth in H1 FY24, having crossed 1 lakh crore rupees. The market volume is poised for an all-time high in FY24. The growth is driven by credit expansion and demand for priority sector lending loans. Direct assignment transactions have always contributed a major portion of the securitization volumes. However, for the first time in the recent history, PTC issuances have just pipped DA transactions by contributing over half of the market volume in H1 FY24. Care-rated securitization transactions have performed very well with no credit losses faced by the investors till date. Though the Indian market volumes for H1 FY24 touched the highest level in recent times, its share in the global securitization market is negligible. We will also be covering the 2008 global financial crisis, also referred to as the subprime crisis, and discuss the key factors which contributed to this. Primarily, risky lending practices and use of complex structures were at the core of this crisis, while high leverage compounded this problem. The exposure of global investors to the US securities and the trust deficit added fuel to the fire, leading to a total freeze of credit markets. However, sound business practices and judicious regulatory oversight have ensured that the Indian market remained and continues to remain quite resilient. With this backdrop, we will briefly touch upon market volumes. We will first look at the overall market volume trends for the Indian markets. In this presentation, we can say, when we say securitization, we generally refer to secondary market for retail loans, covering both direct assignments and PTCs. H1 FY24 volumes have risen by over 40% as compared to the year ago period. The merger of the HDFC entities has resulted in direct assignment transactions lagging behind PTC issuances. For the first time in well over a decade, PTC issuances contributed over half of the volume. The market volume crossed 1 lakh crore rupees in the first half of the year. Given that the Q3 and more specifically Q4 typically witness highest volume of securitization transactions, we expect that FY24 volumes may well be in excess of rupees 2 lakh crore at the end. This will be highest volume ever for the Indian markets. Moving on to the next slide. As can be seen in the chart on the left of your screens, in the first half of the financial year, MBS pools formed a major chunk of the DA volumes at 44%, followed closely by asset-backed DAs, accounting for 35%. The share of mortgage-backed DA transactions has come down compared to the earlier periods. This is largely on account of the merger of the HDFC twins. PTC deals backed by ABS pools constituted 70% of the H1 volumes, with mortgages making up 18%, followed by MFI at 12%. The leading asset class that drove the PTC issuances were vehicle loan pools at around 35,000 crore rupees. With this brief update on the asset class wise breakup of the market volumes, we will now move on to the size of the PTC issuances in the Indian market. In the graph presented on this slide, we have not included bilateral deals done through direct assignments. The main driver for securitization in India is the priority sector lending norms. Non-PSL pools form a small portion of the securitization volumes. While the PTC market is growing, it will be pertinent to note that the size of the PTC issuances in India is very small at 0.04% of the GDP in 2022, as compared to 9.61% for the US. Even in comparison to the size of the retail credit market, PTC issuances are a very small chunk at 1.69% as of 2022. This shows that there is huge potential for growth for the Indian securitization market. Moving on to the next slide, we will look at securitization market from a global perspective with a focus on US markets. We looked at the volumes witnessed in India in context to the overall global volumes. When we look at these numbers, we feel that there is scope for the volumes to catch up and the Indian securitization market has a long way to go. As can be seen from the graph on the left of the screen, the US market saw a big drop in volumes post the subprime mortgage crisis in 2008. The securitization volumes in the US were mainly driven by agency and non-agency MBS transactions. Agency MBS transactions are pools comprising securitized residential mortgage loans that are issued and guaranteed by US government agencies. As can be seen from the graph, at their peak, non-agency MBS pools, which were considered more risky, constituted 55% of the total MBS volumes in 2006. However, after the subprime crisis, their share fell drastically and has remained a small part of the market. This was because an overwhelming majority of the defaults during the crisis were witnessed in the non-agency MBS transactions. It may be noted that the US still commands a lion's share of the global securitization market at 54% in 2022. And 85% of the issuances in the US were backed by agency MBS pools. As can be seen from the graph on the right of your screens, if US volumes are excluded, China leads the way with issuances of over 490 billion USD in 2021, which fell to around 299 billion USD in 2022. India forms less than 1% of the global issuances, which is lower than even Australia, Canada, or Latin America. This analysis pertains to PTC deals only and excludes direct assignments. With this backdrop, we will now look at the historical performance of the CARE-rated securitization transactions before we get back to the GFC. In this slide, we are presenting data related to the rated PTCs, including old rated direct assignment deals, covering all senior tranches rated by CARE since 2010 onwards, covering over a decade, which is a fair representation of multiple cycles of different asset classes, including a minimum of 2-3 cycles of home loans, which have the longest tenure. Apart from the natural calamities which have occurred during the 12-year period, this period also covers the immediate aftermath of the global financial crisis, demonetization, NBFC liquidity crisis, GST rollout, and last but not the least, the pandemic-induced national and regional lockdowns and supply disruptions. In this sense, this period can be taken as covering economic cycles as well as disruptive events. As can be seen in the presentation, the credit rating assigned to the senior tranches of over 99% of the total rated transactions have either never been downgraded or even when the ratings were downgraded, they were reinstated to the original rating. Of the balance, in around 0.58% of the transactions, even though the rating at the time of withdrawal was below the original rating, the investors were repaid in full, including interest. Currently, only around 0.29% of all the rated transactions remain downgraded. However, these instruments continue to be rated in the investment grade, and this reflects the resilience of rated securitization transactions in terms of rating stability. Additionally, while there can be mark-to-market or provisioning costs, there have been no credit losses to senior PTCs rated by CARE. Even if one were to look at the overall Indian market as a whole across different credit rating agencies, the picture would not change much as there have only been a handful of defaults. Moving on to the next slide, we will explore the core reasons for the global financial crisis. There are multiple factors which led to the global financial crisis of 2008. We have attempted to summarize them into 3 or 4 categories relevant to the context, namely risky lending practices, complex structures, macroeconomic factors, and most importantly, high leverage. We will briefly touch upon each of them. Moving on to the next slide, the lending practices eventually reflect on the robustness of the credit markets. Some of the lending practices which may have possibly led to the GFC are exponential increase in the subprime lending, growing proportion of teaser rate loans or ninja loans, which are no income, no job loans. There was a buildup of non-agency securitization prior to the GFC. In 2006, non-agency MBS contributed 55% of the total MBS issuances. Increased prevalence of originate to distribute model encouraged churning higher volumes and laxity in the underwriting standards. In the US, a significant proportion of the underwriters responsible for due diligence of the underlying contracts in securitization transactions were related to the seller, which was around 70% of the transactions in 2006 and 2007. This was a clear case of conflict. If we look at this aspect in the Indian context, the RBI has been emphasizing the importance of credit underwriting and due diligence through the prudential lending norms. Moving to the next slide, the structuring was complex with multiple tranches and multiple layers, with papers being re-securitized over and over. Securitization transactions were backed by leveraged securities and subprime loans. There were ALM mismatches as there was an over-reliance on asset-backed commercial paper market and repurchase agreements in warehousing structures. Under these structures, a securitization at the securitization trust level, either the long-term assets were financed by short-term assets such as CPs, or long-term liabilities had liquidation events making them short-term. In either case, when the credit market froze, such structures could not be rolled over and led to defaults. Resecuritization or CDO squares or cubes with junior tranches as underlyings created complexities around structuring, risk assessment, and pricing. CDS and synthetic CDO structures allowed playing on much larger notional amounts. Moving on to the macroeconomic factors, with an increasing interest rate scenario, the market value of properties dropped drastically, leading to a large number of underwater mortgages, meaning the property valuation fell below the amount of the loan outstanding. Unlike India, in most states in the US, mortgage loans are non-recourse loans to the borrower. This may be a little difficult to digest from an Indian context, but in those states, the lender does not have recourse to the borrower to recover dues against the mortgage loan and has to only rely on the recovery from the mortgaged asset. This led to a phenomenon where there were large-scale defaults on the mortgage loans, but the borrowers continued to service other obligations such as credit card dues, etc. When the interest rate cycle turned and the interest rates began climbing, it led to a rapid rise in defaults, with around 25% of the adjustable rate mortgages or subprime mortgages turning sour. Moving to the next slide, the total amount of subprime MBS was around 3.5 trillion USD in the span of 8 years between 2001 and 2008. We can see that around 70% of the loans were subprime loans, and these were primarily adjustable rate teaser loans. Subprime loans were typically highly leveraged, even though the earning capacity of these borrowers were low. Non-agency MBS transactions, which were financed by private financiers, had grown from 20% of the volume in 2000 to 55% in 2006. Prime mortgages and fixed rate mortgages were not severely impacted during this period. This was about the history of the GFC, and now we look at securitization volumes in the US, which was ground zero for the GFC. Over the last few years, the US market has bounced back. The US market has grown, and the outstanding value of all issuances stood at an all-time high of 13.8 trillion USD in 2021. The rating defaults and downgrades for securitized papers have normalized. The recent unprecedented hikes in the interest rates in the US have resulted in massive mark-to-market losses and failure of a few large banks in the US. However, there is no significant impact on the performance of mortgage loans as yet, and this will be a key monitorable going forward. Now, this raises a question for us. Is there a chance of GFC-like situation arising in India? The short answer would be very unlikely, and the reasons for that can largely be clubbed under two broad heads: market dynamics and regulations. On the market dynamics side, the underwriting standards have been robust for retail loans in India, unlike large prevalence of ninja or subprime loans that was seen in the US. The structuring of securitization deals in India is relatively less complex. In India, we typically have 2 or 3 tranches for PTCs in one transaction, unlike the US, where it used to be as high as 10. The originators have a skin in the game as they end up funding the credit enhancements. Also, the LTVs in the Indian market are generally overstated due to the conservative valuations. The investor has better understanding of the underlying assets and typically has a hold to maturity mindset. Regulatory changes which instituted MHP, that is minimum holding period, and MRR, which is minimum retention ratio requirements, along with credit bureau reporting and the recent changes mandating daily stamping of NPAs, ensure close monitoring of the credits. Additionally, restrictions placed on repackaging of securities and credit derivatives backed by ABS or MBS have also ensured that transactions do not become too complex. Moving on to the outlook, this is CARE's view of how the securitization market would move. The Indian securitization market is poised to register its highest ever volume in FY24. The growth will be driven by the robust credit growth and demand for PSL assets. Co-lending model has the potential to disrupt the direct assignment market volume in the longer term. The overall credit performance of retail credit portfolios is expected to remain robust. With that, I would like to hand it back over to Ms. Divya. Thank you.
Thank you, Sriram. As conveyed earlier, all attendees are requested to key in their questions, which we will take up during our panel discussion. Now, may I invite Mr. Vineet Jain to take over the session, please. Vineet is a Senior Director at CareEdge Ratings. He's a Chartered Accountant and Company Secretary. He has 25 years of experience spread over credit ratings, structured finance, debt capital markets, and corporate banking including NBFC lending and portfolio buyouts. He was a part of the founding team of IDFC Bank and was instrumental in setting NBFC lending business as part of the FIG, Financial Institution Group. He has earlier worked with SBI Capital Markets, Axis Bank, etc. Over to you, Vineet.
Thank you, Divya, for quick introduction, and thanks, Sriram, for the nice presentation. Good evening to all the panelists and participants, and a very warm welcome to all of you. So, largely, I see three key messages from emerging out of the presentation. One is that although the securitization market is at all-time high in terms of volume in India, it's at a very, very minuscule scale compared to other Asian markets or leave aside the Western market. Second message that I get is that the performance of care-rated senior equities have been good with minimal rating downgrades and no credit losses to the investors. And third, while the subprime originated in the US market is now growing for last decade or so, living behind the subprime crisis. And rating downgrades and defaults in US have also moderated. We sincerely hope that all the participants have found the presentation informative, and I'm sure that discussions from our esteemed panelists will also add value to all of us. We have three panelists today for the webinar, and I would like to thank each one of them for sparing time for getting into this panel discussion. Just to reiterate, the participants in the panelist I have their individual views and may not represent the views of the organization that they represent. I would like to quickly introduce the panel members to the webinar, and it's my privilege to speak a couple of lines on each of them. Our first panelist is Mr. Shankar Tripathi. He is the Executive Vice Chairman of Aadhar Housing Finance Limited. He has 39 years of experience in commercial banking. Mr. Tripathi holds bachelor's and master's degree in science from Lucknow University. He also holds diploma in public administration. On functional expertise, Mr. Tripathi has managed various roles in bank covering corporate finance, credit management, retail banking, rural banking, transaction banking, resource mobilization, and whatnot. A very warm welcome to you, Mr. Tripathi. Our second panelist is Mr. Vikas Jain. He is currently Chief Financial Officer at Hinduja Leyland Finance Limited and is a qualified chartered accountant with more than 80 years of experience. He has earlier been associated to Bajaj Finserv, where he was heading corporate audit function for Bajaj Housing Finance. Prior to Bajaj, Vikas was associated with PwC as part of the Assurance Advisory Group for Financial Services. A very warm welcome to you, Vikas. Our third panelist is Ms. Aditi Deshpande. She is a qualified chartered accountant with 20 years of experience in financial services. She is National Credit Head at Aditya Birla Finance, handling loan portfolios such as capital markets, supply financing, supply chain financing, NBFC lending, MFI lending, securitization, fintech, etc. A very warm welcome to you, Aditi. A very warm welcome to all the participants once again for taking time out to attend this webinar. In case participants want to ask any questions on the presentation or otherwise, they are requested to key their question in the panel on the screen. Now we'll begin panel discussions and simultaneously take questions from the panelists, from the participants. While we get questions from the panelists, I take liberty to start with Mr. Tripathi on what are the takeaways from the presentation we made. He can specifically address the question on basically on the MBS volumes. When we look at India, the MBS volumes are very, very low compared to the international levels. So what is it that is causing reluctance on part of either the originators to ramp up the volume, or are there issues on the investor side in terms of investing on the long-term floating rate asset? Mr. Tripathi, your views on this?
Thank you, Vineet, for having me on this webinar. In India, of course, this securitization and MBS securitization is increasing year-on-year basis. As your presentation itself shows that this year 2 lakh crore is likely to be crossed, but globally it is a very negligible amount, mainly because the Indian securitized market was not developed from the very beginning. Only in 2019, when Reserve Bank of India appointed Harshvardhan Committee to recommend that how securitization market can engage with a big pace, then RBI issued the guidelines in 2021 for both for the assignment of pool, that is a DA transaction, which is bilateral, as well as the securitization and PTC rules. Now, coming to the point of whether the originators were shy, originators were initially not shy, but they were also looking the requirement. The requirement from securitization actually is mainly the asset liability mismatch, liquidity, and so many all these things. So now, gradually, if we see the number of originators are increasing, the investors are also coming. Many investors are coming into the fold. The main investor class is actually the insurance fund, the provident fund, the pension fund, and all like that. They do not have a adequate confidence because the Indian securitized market is not developed. It was largely through the DA transaction, that is a bilateral assignment, which were not much transparent. There were a lot of asymmetry was there. So that's the reason the investor who are the big investors or even the large retail investors, they do not have the security through PTC route, which actually as per presentation has gone up during this half year at 50-50. So that shows that unless the large number of individual investors and as well as these big funds come, this market remain confined to the banking system or large NBFCs. Large NBFCs are buying pool from small NBFCs, and banks are taking maximum pools because of their priority sector requirement, because of their you can see loan book increase. The foreign and private bank do prefer the PTC route, but the PTC route, the originator are a little shy. They have twin problem. They want to upfront book the profit. Some are taking profit as a challenge because unwinding has to take place. Secondly, the risk transfer completely happens in the case of bilateral transactions. Why in case of PTC route, they have to provide credit enhancement. And next point which comes from the originator side, originator always believe that their capital will be released in the bilateral transaction. So these are certain parameters which are inducing originators to go for bilateral transactions, which the market is not very key because the appetite is confined only with the banking system and the large NBFC. So unless the securitized market is moving towards the PTC route, the large investor class will not come. What that requires actually, the RBI guidelines has given the quite clarity in both the circulars, one for PTC and one for the DA pool. That clarity has come very in that thing, but government is required to do something. In fact, if government set up a committee or a board for that, which should supervise how the PTC transactions are going to take place. That requires more of a transparency, more of a standardization, and multiple factors are required to ensure that the PTC transactions are quite good transactions, and then only the big fund, insurance pension fund will jump into that. So I personally believe, I understand that SEBI and government is working to create an intermediary to ensure that in case of, at least to begin with, in case of mortgage-based securitization, the PTC transactions start taking place. Market is also growing. Housing market is growing. There is huge requirement of liquidity for the housing finance companies. And so therefore, the moment the bilateral market moves the PTC route, the automatic securitization transaction will go up. I think that in years to come, India will lead the securitization market in the globe. It might take 10, 15 years' time. It is not that immediately it will happen, but it is going to lead. But government has to provide taxation clarity, stamp duty, the transaction cost has to come down, and more of a standardization and thing. The market leaders, market development, and policy have to move in tandem to give a big Philip securitized market. So long as it is confined to DA market, probably it will grow 40-50%, and then the percentage growth, the global transaction will not be that high. So therefore, government is serious about that. Last year also many recommendations they made to the government. This year also many bodies are recommending to government to remove the infirmities with regard to taxation structure, with regard to the reduction of stamp duty and simplify that. So hopefully the securitization market is now poised to grow. One, many originators are in the fray, many investors will come, then actually the Indian economy will see that huge money comes into the banking system or NBFC for lending.
Good. So you have summarized it really well. So essentially, what here means that the government is interested in developing this market. They are doing their bit, and there are more incentives with the originator to direct assignment transaction than PTCs. And probably investors have to get more experience around investing in MBSs. That's largely what you're summarizing. So that's really very nice. And we started getting questions. So first question is probably on the co-lending. So I will turn to Mr. Jain. Mr. Jain, you are active on both sides of the market as a buyer and a seller. In the context of direct assignment and co-lending models, how do you see the contours of market changing with regulatory push for CLM? Or do you see that CLM is more a subset of direct assignment only? What's your take on that?
Yeah, hi Vineet. Thank you so much for inviting this, and a very happy Diwali in advance to all the viewers of your this show. On the co-lending side, Vineet, if I have to summarize, I mean, the RBI has come up with the existing guidelines of co-origination of the loans between the banks and NBFCs for granting, especially on the priority sector side, right? And if I have to, summarize, let's say CLM model 1 and CLM model 2, right? CLM model 1 is largely a prior irrevocable commitment on the part of the bank to mandatorily take its share or individual, loans in its books originated and sanctioned by the NBFCs. On the other hand, the CLM2 model is, largely where bank can exercise its discretion to reject or accept, his share of loan originated and sanctioned by the NBFC subject to bank's due diligence and all. Now, CLM2 model is largely, akin to the direct assignment side, where if there is a, MHP requirement in the direct assignment, but in model 2, there is no such MHP requirement and so other thing. Now, in a near to short run, if you have to see, co-lending as a momentum is yet to get pick up, right? So co-lending is very good in terms of when it comes to the customer transparency as compared to direct assignment, either in CLM 1 and 2, where you are getting disclosed to the customer about that how his customer life cycle is going to be in which book and all those disclosures which comes. Second is if you see the co-lending on an overall basis, right, the banks and the NBFCs come together in a much closer manner, and where they work in on the processes side, they work on organization DNA in terms of like how they have to behave to work around or execute these types of transactions, and this actually helps to get a stronger relationship, which may not be there in the normal term loan relationship from the NBFCs or the other to the banks, right? Now, but the current challenge which stays on the co-lending route, which is not making the right now these things are going very attractive, is that right now both at NBFCs and bank, they have a multiple relationships, right? Or different one NBFC is engaging with multiple banks, and one bank is engaged with multiple partners for the co-lending route. Now, this requires not only the API integrations, but also requires the approval mechanism, the pricing, the other the organizations to turn around the culture of the organization in all the scenarios. Now, this really is a hurdle which in a short to long run it will evolve, and it will evolve in a very good manner. Currently, there are certain intermediaries who is helping in terms of getting these integrations in a seamless and a smooth manner, but still this is a progress to happen. In my personal own experience, when I met with big daddies in terms of the PSU offices and all those things, there is a clear cut, I can get a sense that even banks are more like first let their internal tech infrastructure to get ready then only they want to participate and partner with the the other partners, because they do not want and which is good in a way for this co-lending as a product, because if something which is steady and slow and getting a growth will always have a trusted healthy relationship. So the banks are getting ready for themselves. Their infrastructure will take more time because of their size and scale. But on the other side, the fintech and the NBFCs, want to participate in this journey. Now, to that extent, the counter product is direct assignment, which has always been there from past in terms of utilizing all those things. Now, there is another piece which goes hand in hand, is that these relationships comes between the bank and the NBFCs, right? So it's a dual-edged sword. If the partnership relationship goes well, then everything is good. But if any friction comes, then they also have in turn impact on their existing line of banking relationship, because then you are actually telling us that how a NBFC as an organization behave, in its processes, in its system, in its risk management and all those technology. So even both the sides, it is little slow. So everyone wants to, participate, but they are little slow on the overall piece, if I have to say, on the co-lending piece. But definitely between direct assignment and PTC, if some has to correlate, obviously PTC, as Mr. Tripathi says, carries a very good advantage of either pricing or, the tradable securities and, the enhanced investor opportunity and all those things. And DA always carry a traditional, the merit of getting more leverage, getting a benefit in the CAPAD or capital adequacy. So certain organizations also get the EIS income upfront booking and improve their financial ratio. So these are some of the things where, as we speak right now, DA and PTCs is going to be, the favorable product among the banks and BFCs and all those pieces. But as we move, we get matured, the market get matured, the trust comes, the engagement happens, certain couple of transactions gets, the overall maturity comes, the transaction gets closure in the shorter loans. If it happens, then this will give more confidence to the banks and as well as the participants to enter into the more co-lending opportunities.
Thanks, Mr. Jain. We'll be still on co-lending and we'll move to Aditi. But before that, there are a couple of questions which probably we can take from the audience. So one question is, why do companies prefer TITP structure compared to TIP structure? Is there different loss absorption compared to as per the rating agency? So companies typically prefer TITP over TIUP over TITP, primarily because there is inbuilt cash flow comfort, right? The liquidity mismatches are less pronounced in TIUP compared to TITP. In terms of ultimate loss absorption capacity, I don't think there is any significant difference. That's from our perspective. Mr. Jain, do you want to add anything to this question?
No, I think what you are saying is fairly right. I mean, from the loss absorption capacity side, both the programs fundamentally the risk remains the same. So the loss absorption is the similar on both the sides. But obviously, what you are saying is right.
There's another question, which is, how do you see co-lending disrupting securitization volume since co-lending has been growing steadily? I think that's partly addressed. Our own sense is that the pricing difference in the two is different. And co-lending is business model compared to securitization. Both would continue to coexist. The larger player probably would have little resistance in terms of switching to co-lending model, because India there is that tendency to hold the customer. So because of that mindset of holding on to the customer, probably the larger guys will be a bit slow in terms of adopting to the co-lending model is what we feel on the NBFC side. Aditi, on the co-lending, do you see increased traction? You are relatively a newer player and you have aggressive plans. So what kind of traction do you see on co-lending, and what challenges or advantage do you see in CLM model compared to direct assignment? CLM versus TTC, pretty much everybody is aware, but if you have to compare CLM and DA, do you see drastic differences, or these are largely similar in your opinion?
Thanks, CareEdge, for having me on this webinar. And I would first want to appreciate Sriram for a wonderful presentation. And he made me quite nostalgic by going to the GFC, because back then in 2008, I worked with a very large US bank and was pretty much in the thick of things. So yeah, that was like a recap of those times. Coming back to your question, Vineet, on co-lending, and CLM versus a DA kind of a model. So a lot of things, Mr. Jain, of course, covered on the pros and cons of co-lending versus DA. As an organization, of course, ABFL is moving towards retail loans, and the focus is a lot on retail exposures. So as we are building our focus on building these loans, we believe that DA, instead of DA co-lending, in a co-lending kind of a model, what happens is it's more a business exercise. You are at the thick of things right from the time of origination, onboarding, and getting the clients on your balance sheet early on. Rather than that, DA is more kind of a buyout kind of an exercise. At times, it becomes more a commercial exercise than a business exercise. And we see the thrust from RBI also more on co-lending. Give a good rate return, commensurate rate return trade-off. So these are the asset classes also, which, it's quite interesting. Of course, but coming back to co-lending, I would give the analogy of co-lending to a marriage. Till things are fine, of course, it's a happy time. But of course, when stress starts building, disagreements start. So, there have to be very clear understanding. You need a like-minded partner to work with, and, with a clear understanding and agreement terms of, how things would go ahead in times of stress. Although, there are no credit enhancements as such very directly in a co-lending structure, but there can be, partly some kind of FLDGs or, some other kind of enhancements or, understanding in terms of collection abilities that can be factored in. So, yeah, to sum it up, of course, co-lending is a more preferred business model than a DA.
I agree. The co-lending is much more involved compared to direct assignment or other transactions. That's true. So there is a question from one Mr. Vinay. Would development of ABS market lead to convergence of credit risk and market risk? So our first gut reaction on that would be that the two risks are different. In terms of your transaction structure, whether you are able to pass on the market risk or not, then it's a matter of who is holding that risk and who is managing that risk. I don't think that two risks would actually converge in our limited understanding unless we are missing your question completely. Then there is a question, if NBFCs have access to capital from markets, will it impact the volume of PTC's transactions? I would leave that to Mr. Devshankar Tripathi. What's your take on that, sir?
Vineet, if NBFC is going to access to capital market, then necessarily they have to go to the PTC transaction. Because I tell you, going forward, as I mentioned in the beginning, that SEBI and other government, they are more interested in developing that there is a large capital available in the debt capital market, and the investors should get the fixed income product other than the bond and the corporate bond. So it is NBFC will always like to prefer to capital market to raise the resources and funds. That's one thing. But only thing is, as I mentioned, those NBFC which are going to take advantage of upfront profit, which is a very short-term gain because it has to be unbound, this is not a very beneficial. But capital release doesn't happen. So if NBFC is short of capital, NBFC is hungry of making upfront profit, they have to go to the DA transaction. But if the NBFC is having sufficient fund, then they will definitely prefer to go to the PTC transaction where the interest cost will be slightly lower for them.
Got it. Vikas, your take on this?
So absolutely, I agree with Mr. Tripathi. And in addition to that, if I have to say, like capital market is, having a very, very sensitive in terms of reactions, right? So obviously, if NBFCs are well capitalized, well adequate thing, there are only two ways to look at it. One, they have to leverage on the bank side, or whether they want to go into the PTC mode. Now, historically between DA and PTC, who PTC are being done by the the NBFCs or the partners who is, let us say, from triple B to double A, and where they want to get the advantage of triple A pricing, right? Because PTC carries your creamiest of the cream pool, and the good ratings, good risk assessment, and so forth. So obviously PTC carries a very good advantage of the rate side, and helps the originator to raise money at a very at a pricing advantage side. Vis-a-vis, if I have to talk on the direct assignment side, obviously if you are well capitalized, probably direct assignment may not be as lucrative, because DA is largely, again, gives you benefit a capital advantage, right? And sometimes the pricing is not as competitive to your normal course of pricing which you have from the bank lines. So these are the two pieces which one has to see.
So Himanshu, just to summarize your question, essentially there are three drivers that appears to be there for these transactions. One, many people look at securitization as a mode of financing that would probably get compromised if you have sufficient capital. There are three more reasons probably which I am understanding. One is your capital relief, second is your profit booking, and third, typically in Indian context, the securitization is led by private sector lending asset which commands a premium. So even if we have debt capital market available, the pricing for PSL assets are different, which will continue to be a driver. This is what I'm understanding largely from the panelists.
But Vineet, there is one disadvantage of the DA transaction, because there is cherry picking of the pool.
Right.
If you keep on selling the pool through DA to the banking system, your good pool will go away. Then everybody left with the probably the average type of pool. That is also one disadvantage, which is mostly we are not looking into that. In PTC, that is not happening.
True. There's another question, which is, in the long term, securitization can be through technology platforms, or will it have to continue the traditional method of sharing pool, etc., via email or or drives? So, short answer to that would be, any wholesale transaction in our limited understanding would have to be probably continue because the diligence requirement is different. Technology plays a part where things can be in STP mode, or some advantages there. In wholesale, the diligence requirements are different. So probably yes, technology could add some value, but at this point of time, at least we see little possibility of transactions moving to technological platform on the wholesale side. Co-lending, it might make much larger sense. There is another question which is largely on originate to distribute model. So in the US, one of the thing was that there was prevalence of originate to distribute model, and that probably led to relaxation in the underwriting criteria. So how does that compare with Indian context? Because in India also we see originators originating for sell down. So would you like to take that, Vikas?
See, whether the whatever pool you are originating, either for sale or put it on this, the risk management or the portfolio optimization has to be in the similar form and fashion. Because if you miss that particular thing, in a long run, again your pool's performance will go down. If the pool performance goes down, then it fundamentally impacts your ability to do further the securitization and the pricing. So your pricing and your ability to raise money through the securitization is an outcome of your the past performance, and you have to be very whether you choose through for the securitization or your own pool, this has to be at a same level.
Mr. Tripathi?
Yeah, I think Vikas has very aptly put it forth. Here I will just add that in smaller NBFCs and those who are short of capital, they are going to be vehicle of the banking system to originate and distribute. Nothing wrong in that. But in India, the Reserve Bank of India is very particular. You see, a lot of regulation has come up where they are giving trust and outsourcing, credit quality, and so many things. And the moment you think that I will sell anything, like in the US, you are out of the market, as Vikas has mentioned. So if some company has got a thinking of a future of 1 or 2 year or short term, they can do this thing. But if you have to stay long term, you have to ensure that quality of your credit, the pool you sell, the performance of the pool is excellent. Otherwise, nobody is going to buy it, whether it is DA transaction or PTC transaction. So according to me, that what Vikas has mentioned, I fully agree with him that the quality has to be remain intact if somebody wants to be a long-term player in the system.
So one key difference when we compare this with US market originate to distribute model versus India, the US market, it was originate to distribute where underwriting were relaxed and there was no skin in the game for the originator. And again, the investors, few of the investors, not all, few of the investors had poor understanding of the underlying asset class. Where we compared that to the Indian context, people originate it, hold it for some time, and the buyer does its own diligence. So that's where the originate to distribute, which is being referred to in the US, and what is in India is quite different, is what we believe. There is another question on can you please elaborate on the non-recourse loans? So this is a peculiar phenomena, right, which was existing probably only in US. We are not aware of other geographies. So this is a concept which is probably alien to we as Indians, right? If you borrow, you have to pay back. In
Correct.
few of the states in the United States, the mortgage loans were non-recourse to the borrower, essentially implying that if you are taking a mortgage loan, you don't have the lender can't sue you for recovery of shortfall in case the property prices go down. So that's a different concept. Doesn't apply to whole of US. Only a few states or most of the states have that regulation where mortgage loan are non-recourse to the borrower, and in case there is default by the borrower, you have recourse only to the property. You can sell the property, and rest of the amount you have to write it off. It does impact the bureau score of the borrower, but you can't legally sue and recover that money from the borrower. That's what it is on the non-recourse loan. Aditi, what kind of asset classes you are finding interest from the investors' perspective, and do you see increased interest for buying and selling of unsecured loans?
Beneath off late, of course, the preference has moved more to secured asset classes than unsecured. We are seeing all around, even regulators, kind of giving a word of caution on the rising unsecured loans throughout the industry. In terms of, securitization, the preferred asset classes, of course, for us are secured small business loans. We of course are into mortgage loans as well, but with HDFC merging with HDFC Bank, there is reduced trend, and there are reduced volumes on the mortgage backed loans. The flavor of the season more are three large asset classes: secured small business loans, vehicle loans. With a good monsoon this year, the collection efficiency of tractor loans, CVs, have improved. So vehicle loans is another asset class which kind of interests us. And the third is microfinance. There has been a big turnaround in the microfinance story. In the last 6 months, almost 40% rise in the credit growth of NBFC MFIs. We see a huge improvement even in the asset classes. There were a lot of large MFIs which during COVID had stress, but they've cleaned their balance sheet now. Some of them have sold their assets, stressed assets, to ARCs, improved the risk underwriting norms, raised capital. So MFIs is another segment which is of big interest to us. There is a good rate return, classes give us a lot of interest. And as the securitization market is getting more more matured, there are a lot of other market savvy investors like HNIs, AIFs, family offices. Even our wealth segment is seeing a lot of increased traction from private credit investors into securitization. So we see that this momentum will certainly increase, and there'll be more preference towards secured asset class PTCs.
Okay. There's a question: can securitization be carried out for loan under principal moratorium? The answer probably is simple no. And coming back to Vikas, the interest rates has risen in the recent past, and that would negatively impact the ability of the borrowers to repay, right? That's one part on the asset class performance. Second is, do you see any correlation between higher interest rate and higher volumes for PTCs?
See, on the interest rate, if I have to say, let me put this way, okay, what is the composition for the securitization as a overall interest structures or deals? One is obviously there is a correlation of either the benchmarking coming in either MCLR or maybe the bank's HBLR and so with the credit spreads going on there. Second is, let us say, the servicing fee structures, whichever is there in terms of the overall, the originator being, the servicer. Now, with these two correlations, yes, you are right. When there is a rising interest rate scenario, obviously PTC is a very, very lucrative form of, protecting the current state of things by two ways. One, obviously PTC has advantage not only on the if let us say the either banks or any other thing where there is a capping coming in terms of the overall limits on the sanctions. PTC gives you a 2x liquidity on that side with any bank or any person on that side. So first is that. Second, once the liquidity comes, right, obviously the pricing negotiation power goes back to the originator, because when the liquidity is coming back to the originator, then the originator also tries to, make sure that he is getting the best of the deals, because he is also putting largely, as you mentioned in your, Sriram mentioned, PTC is being originated in the PSL portfolios. Obviously, PSL is a very, very lucrative form of things where the some of the PSU bank or private banks has a requirement to onboard these customers. Now, getting into the again at a product level thing. See, vehicle and other asset backs where we see is a fixed loan scenario, right? And vis-a-vis PTCs, you may have certain either variable rate structures. Now here there is a conflict after certain point of time. Obviously, rising interest rate scenario may not get that advantage once you are the band between gets narrow between the normal banking lines versus the PTC lines. But vis-a-vis in the mortgage side, you have an ability to pass on to the customer. But again, in that side, the bank and NBFC sees that whether if I increase my rates to the customer, whether how will be my attrition will be there, because the rising interest rate scenario is not going to stay for the entire 10 years. So obviously the NBFCs or the other originators will do that math where they will see that okay, if I have to absorb this rising rate for the 1 or 2 quarters or the year, then probably they don't want to get into the attrition cycle, because the account is going to be more profitable if you keep those account on your book. So there is a direct correlation, but there are nuances to check those correlations, whether they want to go ahead with the rising interest rate scenario with the increase in PTC. Because if these are the 2-3 things, probably somebody may want to hold his even rising interest rate scenario also to have the lower volumes and putting at some other the structures where they can get into, which may be beneficial.
It looks that we are going to overshoot time by maybe 5 minutes, so we'll take last 2 questions. One is on the regulations. So what are the regulations which have enabled or are positive for securitization market in long term, and what are the key challenges? So maybe Aditi, do you want to take it?
Certainly. So, the regulators have played a very important role here. RBI came out with its securitization guidelines last year, and one, it stopped any loans with residual maturity of less than 365 days. So there were more seasoned and more long-term kind of loans that we were that were allowed in securitization. The minimum holding period, the minimum retention ratio, all these regulations made the market more conducive. SEBI also has played a very important role here, and by giving so much of accountability to rating agencies like you. And there's a very important role that even you play in ensuring that the credit quality is kind of ascertained, and we've seen the performance of the pulls rated by CARE and seen that has been very favorable. So regulators have played a very important role in ensuring that investors are more and more keen to invest in PTCs, and this has been a very favorable change.
Okay, so largely the regulatory developments around securitization which are positive is a specific regulatory guideline, that's one positive. Specific taxation framework is another positive. In regulations, there is requirement of MHP, MRR, how much credit enhancement can be there, criteria around true sales. So all those have eventually helped the market. And if you look at in the Indian context, the market has been largely resilient in last few years. And even in 2008, I don't think securitization market in India really had performance issues. The volume did went down, but performance issues were not there. So we'll take last question, which is on subprime lending. So maybe I would request Mr. Tripathi to take that. I'll just put the question. The context is largely that when we talk of affordable housing or unsecured lending or microfinance, people tend to compare that to subprime lending, and that's the larger question that is there. So in that context, I would just give my assessment in terms of how I am reading this question, and then probably Mr. Tripathi can add. When we talk of US context subprime lending, we largely refer to mortgages which didn't meet the certain credit conditions. Now, these included ninja loans, which is largely no income, no job, no asset loans. So they were lending to people who had no job, no income, and no asset. And then there was also prevalence of teaser rate loans, which essentially mean that when you borrow today, you don't have to pay any interest, or you have to pay very low interest, and then you have to make it up in the subsequent years. So these were the two categories, at least where subprime lending is referred to. And these are the two asset classes, or there are two kinds of lendings which faced high level of default during the subprime crisis when the property prices fell. Now, coming to the Indian context, we keep hearing day in, day out referring to affordable housing and microfinance as subprime lending. But actually, these lacks the basic characteristics of subprime lending, what we have seen in the US. Most of the loans in the Indian context are given for productive purposes, and rarely do we see any mainstream lenders, including affordable housing finance companies, microfinance, and NBFCs, extending loans to persons who don't have income, job, or collateral. So that's the larger assessment that we have. I would request Mr. Tripathi to basically take this question. Do you see any prevalence of subprime lending in the Indian context in any asset class? What's your assessment, sir?
Yeah, Vineet. US approach was not subprime lending, it was subprime approach, I can say. Their overall approach was subprime, whether it is selection of borrower, whether it is credit process, whether it is right price for the lower interest rate were there and they were giving the property prices had gone up. They were not taking into the account the most important aspect, which all Indian NBFC, HFC banks are mandated, that the ability to pay up has to be assessed. Here, each and every loan, whether it is an unsecured loan, whether it is a ABS loan, whether it is a mortgage-backed loan, all loans are assessed based on the repaying capacity. Even in the gold loan, also the RBI has given mandate for keeping LTV. So the exposure norms, everything has been done. In India, whether it is affordable housing or any housing is concerned, the selection of borrower, due diligence of borrower, the evaluation of the credit assessment properly, the technical assessment is property evaluation, and then the legal evaluation, the legal appraisal. All these four appraisals are done by every lending organization. They are not just taking money and giving loan. That's the reason, if you see, right from the demonetization, thereafter GST, because these most of the informal segment borrowers, they are small business people and they were supposed to suffer more. So you have seen three times crisis. One, demonetization. Second problem came for the GST implementation. Third, the most important was the most difficult was the COVID problem. The entire affordable housing finance has undergone three difficult litmus tests. And your rating itself says, and the entire country says, that NPA, it gone up during the COVID time, but the restructuring saved that. And thereafter, the performance of the assets, whether it is a mortgage loan or any asset class, excepting in unsecured loan, where slight uptick is there in the NPA, but that is also considering the interest they charge, that is the risk-adjusted return is fine. So I have not seen, despite all these three difficult processes, that there has been any stress on the loan portfolio. Whether if you see the performance of even the banks or every organization is, in case of quality of loan, is getting better and better. So India subprime will not come because here largely the loans are need based. People are shy of taking the loan. In case of mortgage, the LTV is prescribed, and the all four appraisal, which I told you, these are very important, which every lender takes place, and bureau plays an important role. The bureau gives a lot of information to each lender to know about the borrower's the status, his borrowing, or even that there are various alternate data are available. So here appraisal is not simply done and you have income, you take the loan. If somebody has a 5 crore property, doesn't have repaying capacity, he can't take 1 rupee loan. We are not lending to sell the asset. We are lending to get the cash flow of his income. That's all. That's why I don't foresee that there is going to be a subprime problem in the country unless the COVID situation prevails for years together. And then the regulator has come into the picture, and our regulator has played a very important role in India by providing moratorium restructuring to support the borrower. I am in that segment. My average ticket size of loan is 9.5 lakh. And we are largely, as on date, having NPA of 1.25, 1.3%. And so the all lenders which you are rating or others are rating, you can find out.
Yeah, you have really summarized it very well, and RBI, the regulators have been really supportive in the times of real crisis, which impact systemic issues. Basically, have been addressed really well in the Indian context. There are a few questions, but unfortunately, we have run out of time, so our apology, we could not take all the questions. Thank you all the participants, and thank you, Mr. Tripathi, Vikas, and Aditi for your perspectives. Thank you. Over to you, Divya.
Thank you, Vineet.
Thank you,
Vineet, for moderating the session, and Sriram for your presentation. We would once again like to thank all our guest speakers for their insightful views. It was a privilege to host you. Lastly, thank you to all the participants for taking time out and being a part of this CareEdge webinar. For any further queries, feedback or suggestion, please write to us in the feedback mail. Goodbye for now, and I request the tech team to kindly log off.